Form 8938. My name is Vinay Navani, and before we get started with the meat of the presentation, a few administrative items to go over. Use the questions pane in the GoToWebinar dashboard to submit any questions or comments you have as we go through the presentation. We have a lot of material to cover today, and we're going to try to address questions at the end. If we're not able to get to your questions, we will follow up with you via email after the webinar. The presentation will be 1 hour, and at the end there'll be a slide with the contact information for the presenters. At some point after today's webinar, a copy of these slides will be on our website, which is www.wgcpas.com. Throughout the presentation, we're going to have a few polling questions. They'll pop up on your screen. Any of the attendees, some of you are signed up for CPE and CLE, and for those of you who want that credit, it's imperative that you do answer the polling questions. And finally, please send us any comments you have or suggestions for future programs. Today we're going to take a look at the details behind the new IRS Form 8938. The presenters are Parag, Patel, and myself. Parag is an attorney with the Patel Law Offices in Metro Park. His practice concentration is in tax, business law, and estate planning. He's worked extensively on complex tax and estate planning issues and other tax-motivated transactions. Parag was recently named as a New Jersey Super Lawyer Rising Star by New Jersey Magazine for tax and estate planning. He was the 2010-2011 chairman of the tax law, estate planning, and probate and trust committees in the American Bar Association's GP Solo and Small Firm Division. He's a certified estate planning law specialist, certified elder law care attorney, and frequent speaker at seminars on legal issues affecting tax and estate planning. He also serves as a part-time municipal court judge for Edison Township in New Jersey. As for me, I'm the director of tax at Wilkin Guttenplan in East Brunswick, New Jersey. My client base includes emerging and established businesses in the high-tech and software industries, as well as other closely held businesses along with their owners. I spend a good amount of time with income tax planning and compliance matters such as business sales, restructurings, retirement plans, charitable giving strategies, tax audits, and other topics. I also work a lot with U.S. citizens living overseas and U.S. tax aspects of international businesses that have operations in both the U.S. and in abroad. So at this point, we're going to start the presentation, and Parag is going to give us some background on today's presentation.
Okay, great. Today we're talking about 8938, but 8938 actually is an IRS form, but it is a result of two different acts. The Higher Act in 2010 encapsulates the Foreign Account Tax Compliance Act, and that, I believe, is a result of President Obama's campaign in 2008, where he publicized that there were a lot of taxpayers that had foreign accounts, and the goal of this act was making good on that promise, and also, of course, it combats tax evasion by U.S. persons. And essentially, you had to pay for this act, and that is what 8938 is about, as well as information sharing in the year 2013 that comes about for foreign banks. And it's required, it's something that everyone should know about, that after 2013, foreign banks are required to withhold on payments to, or U.S. banks are required to hold on payments to foreign banks that don't necessarily provide information sharing regarding their U.S. taxpayers. So 8938 is encapsulated in Internal Revenue Code Section 6038D, and the form is required for all tax returns filed after 2010. So it's going to be required. It's required for 2011's tax return. So with that introduction, Vinay, I think you're going to be talking about for quite a while Form 8938 and going through all the intricacies.
Exactly. So we really split up the Form 8938 presentations into two parts. One is going to be kind of some of the background and key terms, and then towards the end, we're actually going to look at the form and go through it line by line. So we're going to do that at the end. If you haven't had a chance to do so, try to open up another window and try to have the Form 8938 available, because it will be helpful to look at that. Now, I was starting to write an outline for what we were going to talk about, and I didn't have to, because the IRS instructions do a pretty good job. When you look at who must file, it says if you are a specified person that has an interest in specified foreign financial assets and the value of those assets is more than the applicable reporting threshold, you've probably got to file. I don't know what the rest of it says. But I've underlined some of the very key terms that are really going to be very important to us in this presentation, and we're going to go into each one of them in more detail. So who must file Form 8938? Are you a specified individual? And who is a specified individual? Specified individual is more or less somebody who is treated as a U.S. taxpayer subject to tax on a worldwide income. Not exactly, but for the most part. If you're a U.S. citizen, or considered a resident alien, so that means somebody who is a green card holder or is in the U.S. for enough days to meet the substantial presence test, they will be considered a specified individual. That's going to be most of your filers. In some cases, you can have a non-resident alien who makes an election to be treated as a resident alien for purposes of filing a joint return. One spouse is in the U.S., one spouse is in the U.S., the other spouse is not in the U.S. In order to file a married filing joint return, that non-resident alien spouse might make an election to be treated as a U.S. person. So in that case, you would be a specified individual. Now, currently, only individuals are required to file Form 8938. If you are a single member LLC or a grantor trust, so that for tax purposes you look through those entities, then assets owned by those entities are going to be subject to the requirement because they're going to be considered to be owned by the individual. We're not really going to talk too much about the F-bars, but the F-bars, if you're familiar with those, they have their own completely disjointed set of rules. The Form 8938 is a tax form, and it really borrows and utilizes a lot of tax concepts that you find in other parts of the code. Okay? So, the reporting thresholds. We have a whole myriad of different reporting thresholds that might cause you to have to file. There's two criteria. You look at your value of your maximum value of the assets during the year, and then you also look at your value of your assets at the end of the year. Okay? So at the lowest threshold, if you're an unmarried person living in the United States and as of December 31st you have foreign financial assets of more than $50,000, you need to file Form 8938. But let's say at the end of the year your aggregate value of assets is $40,000, but during the year at any point it was $120,000. Then in that case you'd have to file Form 8938 as well. So you have different requirements based on your filing status, unmarried living in the U.S., married filing a joint return, and married filing a separate return. The IRS also recognizes that if you're a U.S. citizen or resident alien but you're living abroad, you're going to have more financial assets, and they've given higher thresholds. So if you're married filing a joint return and living overseas, you know, you have a $400,000 and $600,000 threshold. Okay, so keep that in mind. And there we go. We look at value determined on the last day of the year, the highest balance during the year exceeding either triggers the reporting requirement. Now, to qualify for those higher thresholds, if you're living abroad, the code looks at the other set of rules under Section 911, which allows you to qualify to exclude a certain portion of your earned income. You don't have to have income that's excluded, but you have to meet the rules. And usually it's one of two tests. Either you're out of the U.S. for 330 out of 365 days, known as a substantial presence test, or the foreign home is really your domicile, for lack of a better word. You're really a bona fide resident of the foreign country. Okay? So now let's talk about value. Value is really important for two reasons. Obviously, to find out if the Form 8938 is required, and then if it is required, we have to disclose the value of each asset that we're going to see as we go through the form. Now, the form says to use fair market value, and they refer us to use general tax law principles to determine fair market value, and we're going to talk about a little bit more about that later. You first determine the value in the foreign currency. If you have, there's no such thing as negative value, so if you were to have an asset which was a net liability, it would be considered a zero value asset. Okay? And the the instructions tell us to use the periodic statements as are a good gauge of value unless you have reason to know that they don't, for some reason they don't reflect the maximum account value during the year. So if I have 2 month-end statements, one for June and one in July, but I know that during July my value spiked up, then I can't rely on the month-end statements. Now, I put 2 quotes here from the instructions referring to value. I'm going to read them. In most cases, the value of the specified foreign financial asset is its fair market value. An appraisal by a third party is not necessary to estimate the maximum fair market value during the year. And the other quote is, in most cases, you may use the value of the specified financial asset other than a financial account as of the last day of the year unless you know or have reason to know based on readily accessible information that the value does not reflect a reasonable estimate of the maximum value of the asset during the tax year. Now, the reason I put these 2 quotes here is I read them to mean that the IRS is not going to beat us over the head if we don't have value exactly right. And they're telling us don't spend a lot of money and effort getting third-party appraisals. I think what these 2 quotes are saying is be reasonable, use your best judgment, and as long as you're disclosing that, you shouldn't have problems running into value, because as we get into non-publicly traded securities in foreign countries, value is obviously a very difficult thing to figure out. So again, maybe I'm reading too much into it, but I see that this is being the IRS recognizing this fact by these 2 quotes. If I have a trust, I look at the value of my share of the trust. And if I have a value in a foreign estate, foreign pension plan, or foreign deferred comp plan, I use the value, if I know it, of my interest. I may not know it. And if I don't know it, then they allow me to use my distributions. If I had no distributions and I don't have any other information, I can use 0. Now, many assets are owned jointly, and you get to some unusual results here. The general rule is that you always use the entire value of the asset, not just my portion or the taxpayer's portion. So if I own 10% of an asset and the other 90% could be owned by U.S. or non-U.S. people, for the most part, I'm putting the value of the entire asset, not just my 10%, to figure out if I have to file the form or not. If I own an asset jointly with my spouse, we use the joint value because the 8938 is going to end up on a joint return anyway. If I own an asset jointly with my spouse and we file separate returns, we each use 1/2 the value. Okay, that's really the only exception that I'm aware of, that you don't use the full value when you're trying to figure out your Form 8938 requirement. If I own a joint with the spouse and my spouse is not a U.S. taxpayer, again, total value, joint with non-spouse, total value of the asset on my Form 8938. If the asset is denominated in foreign currency, which in the most of the time they will be, we first determine the maximum value of the foreign currency. Now, an interesting twist that the IRS has imposed on with the Form 8938 is they're actually directing you as to which foreign exchange service to use. You have to use the U.S. Treasury Department's Financial Management Foreign Exchange Currency Rate. I know with FBARs and other currency translation requirements, I'm not aware of any directive to use a particular service. We've used a couple of internet available sites to find out the foreign currency exchange rate. And I'm not sure to what extent the IRS is going to be enforcing this, but they do make it very clear that you're supposed to use that particular service to get the currency translation rate. And only if the Treasury Department service doesn't have that currency, you can use another source. We are directed to use the currency exchange rate as of the last day of the year, regardless of situations if the maximum value was not on the last day of the year, or even if the asset was sold prior to the end of the year. You're supposed to use the currency value on the last day of the year. So now this is really the meat of it. What is a specified foreign financial asset? Oh, do I have a polling question. It's time for a polling question before I get ahead of myself. A third-party appraisal is required to complete Form 8938 for all foreign private business owners. True or false? Okay, again, if you're taking this for CPE or CLE, you need to fill out you need to answer the question. And we have most everybody has voted. We'll keep it open for about another 15 seconds. And okay, so let's close the polling. And of course, everybody, people were listening, so thank you. It is false. You're not required to get a third-party appraisal. So now we'll go into the specified foreign financial assets. Two main categories: the foreign financial account, a foreign financial account maintained by a financial institution, and foreign financial assets. Now, the first category, financial accounts maintained by a foreign financial institution, is where you're going to see most of your overlap with the FBAR filings. Okay, so you have traditional deposit type accounts, the bank accounts, or you have custodial accounts that may hold securities, things like that. In some countries, you have these stocks that are considered demat accounts, are very common. So what is the definition of a foreign financial institution? In addition to the normal rules you would expect, a bank, it also includes a business, somebody engaged in the business of investing, reinvesting, or trading in securities, partnerships, interests, commodities, etc. So that category really pulls in things like foreign mutual funds, foreign hedge funds, foreign private equity funds. Okay, so those types of investments are going to fall into this first category of foreign assets. Now, let's talk about some foreign financial assets. If I have assets held for investment that are not held in an account maintained by a financial institution, so I own shares in a UK private limited directly, that's going to be a foreign financial asset. If I have a loan to someone in a foreign country, that's going to be considered a foreign financial asset because that's a note, bond, debenture, or other form of indebtedness issued by a foreign person. If I own an interest in a foreign partnership, that's considered a foreign financial entity. Okay? Or more broadly, any financial instrument or contract that has a non-U.S. counterparty is going to be included, as well as an interest in a foreign trust or foreign estate. Foreign deferred compensation plans with a foreign employer or a foreign pension plan is going to be included in this list of foreign financial assets. So as you can see, the list of foreign financial assets is really very broad. One of the exceptions is foreign Social Security. So if I have an interest in a program like that, I'm going to not have to include that. Let me go back here. One of the most common questions I get is, I own a piece of real estate in a foreign country. And generally speaking, real estate is not a foreign financial asset. The IRS actually came out with some frequently asked questions about Form 8938, which they posted on their website 2 days ago on the 29th. And that was one of the things they addressed. But before you jump to that conclusion, you have to make sure that the taxpayer owns the real estate directly and it's not in a trust or any sort of entity. In many countries, especially in Latin America and South America, for non-citizens to own real estate, it has to be in some sort of trust or other sort of vehicle. And in that case, you would own an interest in a trust or a foreign corporation, and that would be the foreign financial asset. Okay, so it's very important to take a further step. So if I own a specified foreign financial asset, the next question is, do I actually have an interest in a specified foreign financial asset? It may seem a little bit duplicative, but it's an important criteria. So the question you have to ask yourself is, if that specified foreign financial asset paid a dividend, or if I sold it, would I have a potential gain or loss? Then chances are I have an interest in a specified foreign financial asset. Even, of course, if I didn't sell it or didn't have a dividend, but if I'm entitled to income associated with that asset, then I will include it. If I have made an election to report my kids' income and dividends on my personal tax return, then I, as the parent, am considered to have an interest in the specified foreign financial asset, even though legally it may be owned by the child. Grantor trust, like we said at the very beginning, the grantor trust is generally disregarded for U.S. tax purposes. So if my grantor trust owns a specified foreign financial asset, then I, as the grantor, am considered to have the Form 8938 filing requirement. Interest in foreign estates and trust. In some cases, I may not know that I am a beneficiary of a foreign trust, so I can't be required to report on something I don't know about. But if I do know about it, I need to report it. And it's very clear that receipt of a distributions is considered knowing it, as obvious as that may seem.
Vinay, there's one interesting, before we move on, which is
Yes.
the next slide dealing with exceptions. One section that I think that deserves some time is a question which is innocently put, but I think that is explosive, and that's on the very first page of 8938, where they ask about account numbers and deposits and things like that. Question 3 asks when it was. They don't ask when it was open, but they ask, was it open during the tax year or was it closed during the tax year?
Right.
And I think that that deserves some attention. If you don't check whether it opened during the tax year, I presume that, what does that mean? That
means that it had to have been run in a prior tax year.
Right. And that has a cascading effect, and that is there are multiple implications from that. I would think that, number one, if you're filing 8938, and if you don't check that it was open during the tax year, essentially you're giving the IRS information to be used against you, saying that you had an account in a foreign account prior to 2011, in which case you had to file probably an FBAR. You probably had to file disclose it on your
Schedule B.
So, for example, if you opened it in 2010, you have to file an FBAR for 2000, foreign bank account report for 2010. You had to report it on your Schedule B, and I think you have to answer that question at the very bottom.
Yes, yes. So in theory, you may have had an account with $2,000, and you may have had other specified foreign financial assets to get you to the reporting. So you may not have had to file an FBAR, but you certainly would have had to answer the question on Schedule B. And this whole conversation assumes that the person didn't do what they were supposed to have done and weren't reporting this correctly all along. But you're absolutely right. If they haven't been, this is kind of a smoking gun, if you will, as to prior exposure.
So it's a trigger, and prior to filling this out, you probably have to have a conversation with the client, because by filling this out, yes, you're giving, you're required to, and you're giving disclosure to the IRS, but you're, for lack of a better word, incriminating yourself, I think, because there are criminal penalties for failure to file those older years, and this could lead to probably something that can be used against you.
Correct, absolutely correct. And we're going to talk about towards the end about penalties and the IRS OBDI programs and similar things. But you're absolutely correct, Parag. It is a very important aspect. So let's talk about exceptions to filing Form 8938. We like exceptions. If I'm not required to file a Form 1040, I don't have to file Form 8938. If I have a foreign asset held by a U.S. financial institution, so my example is Nestle stock owned in a Merrill Lynch brokerage account, I don't have to file Form 8938. If I have a domestic branch of a foreign bank, so the New York office of the State Bank of India, or the flip side, the New Delhi office of Citibank, would not be, those accounts would not trigger a Form 8938 filing requirement. And if you look at the FAQs that came out, again, 2 days ago, they elaborate on these a little bit more. Okay, we're going to skip over that. All right, here is the biggest exception that most taxpayers will be relying on for Form 8938. If you are required to file any of these forms, other forms that are listed with respect to your foreign ownership of your asset, you still have to file Form 8938, but your filing becomes much, much simpler. Okay, so this is an important list of forms, so let's go through it. Form 3520, which deals with transactions with foreign trusts and receipts of certain foreign gifts, as well as foreign inheritances, receipt of a foreign bequest, is reported on Form 3520. Form 5471 is a form that's required to be filed if I have an interest in a certain foreign corporations. Form 8621, information return with respect to a passive foreign investment company, otherwise known as PFICs. Foreign mutual funds are included in that category. Form 8865, U.S. persons that have an interest in certain foreign partnerships. In Form 8891, U.S. taxpayers that have an interest in a Canadian registered retirement plan. So if you have any of those scenarios and you're filing those forms, then your Form 8938 requirement is much easier. Pay attention, and the penalties for not filing any of these forms are pretty steep, so you want to look at that. Now, I will talk about the Form 5471 for a second. There are many situations where I might have a 10% interest in a foreign corporation, and I may not have to file Form 5471, but I will have to file Form 8938 if I meet the other filing requirements. And even if I do meet, even if I am reporting my assets in one of those other forms, I still have to consider what the value is to determine if I have a filing obligation. So I may own shares in a UK private limited, and I don't have to put too much detail about the UK private limited on the form, as we're going to see at the end. But what we're going to do is I need to figure out what my value is, so I can determine am I less than 50 or more than 100,000, whatever it is, so I can figure out if I have to file the form. Okay. Do we have a polling question? Okay, here we go. Which of the following are not specified foreign financial assets? Not foreign financial assets. A foreign securities account, deferred compensation plan with a foreign employer, vacant land in a foreign country, or interest in a foreign partnership. Okay, so please vote, and as soon as we get most of the votes in, we'll move on to the next part of the presentation. So we'll keep it open for about 10 more seconds. Okay, so of course the answer was vacant land in a foreign country. That's not a financial asset, and most of you got that right.
So Vinay, before we move on to the penalty section, I had a question. If you have a client that received, let's say, a foreign bequest of land, non-income generating land, let's just use that as an example. So is there an 8938 obligation there?
If I received a bequest of land, I would have to file a Form 3520 to report that inheritance. But no, I don't think that I'm out of my 8938 requirements.
So you'd basically say you fill out the top part of 8938, and you would not disclose that asset on 8938, and just simply at the very end of 8938 indicate that you're filing a 3520. There's one form there, and that takes care of it.
Well, actually, let me stop you, because if that's the only asset I have, that land, that's not a specified foreign financial asset. So I may not even file Form 8938 in that case.
In that case, just filing a
3520. Right.
And that would be presuming that you inherited that asset during the year.
Correct. Correct. And as Parag is going to talk, well, Parag, you're going to talk about penalties now. And one of the messages behind, as you're going to talk about, is the penalties are so steep that anytime you have any questions in the world of Form 8938, it's always better to err on this side of disclosing, because you really have nothing to lose, and you do have a lot to lose if you should have made a disclosure and you didn't make a disclosure. So
that's a good entree to the next section, which is what there is to lose. And if you remember anything from this section, they are severe penalties here. They're very significant. They are new penalties that don't otherwise apply, and it's a real incentive to disclose. And that's the real reason why we have these. They impose these penalties in the first place. But we'll go through it. So the very first thing is if a failure to file a penalty. It's $10,000. It's by the due date. So, for example, for this year, it's April 15th, or the pretended due date they're from. And if the IRS, for whatever reason, sends you a notice that you failed to file the return, the 8938, then there is an additional continuing failure to file penalty, which is $10,000 for every 30-day period. Maximum penalty is for 5 months, so it's a $50,000 penalty. That would be in addition to the first penalty. And if that is not enough, then you have the accuracy-related penalty. And this is different from the normal accuracy-related penalty that we may be all familiar with. This is a special accuracy-related penalty only for undisclosed specified foreign financial assets. That penalty is 40% of that underpayment, of the undisclosed asset. I would think, Vinay, I guess that's in addition to the regular accuracy-related penalty. I'm not certain.
I'm not certain, but if I had to guess, I would say probably yes. But I'm not certain either.
Well, you know what? The regular accuracy-related penalty is based on the amount of tax due. So perhaps this is maybe different. I'm not certain. Hopefully we'll never need to know that.
Hopefully never need to know that. These penalties are so expensive. Let's hope that we're not there.
Now, there's also a fraud penalty, which is 75%. And these are all percentages of the underpayment due to the fraud. Now, the underpayment due to the fraud, now this is really a reporting form, so I guess we're talking about the underpayment would be the tax due as a result of the foreign asset that was undisclosed?
I think it would have to be.
So, these are large numbers. These are large numbers. So let's go through an example. There are a couple examples, and these are just really straight out from the form in terms of the accuracy-related penalty. If you don't report ownership of shares in a foreign corporation on 8938 and you subsequently receive taxable distributions and you didn't report that taxable distribution, that's an example of the accuracy-related penalty. If you have ownership shares of a foreign company and you didn't report the gain, as you should have on Schedule D, then that's another instance where they would assess the accuracy-related penalty. And if you don't report foreign pension income and you receive a taxable distribution. So yeah, I guess these are on the underpayments.
Right, attributable to the omitted asset.
Right, so this is, no, these are very significant. The presumption of maximum value, if the IRS learns that you own a specified foreign asset, the burden is on the taxpayer to prove that the value doesn't give rise to an 8938. So the burden is on the taxpayer, and there's a presumption of maximum value. There's a reasonable cause exception, which is typical that we have here. I believe it's the standard, the same standard that we're normally familiar with, where you have reasonable cause to get this penalty abated. The fact that a foreign country would impose a penalty on you if you disclose the required information, unfortunately, does not constitute reasonable cause, so you can't rely on that. And the very last thing, actually, I think is the most important thing, and that is it's not a penalty, but it's an extension of the statute of limitations. If you fail to emit from gross income anything that's required to be disclosed as a specified foreign asset, and the omission is greater than $5,000, then the statute of limitations, which is normally 3 years, jumps to 6 years from the date the return is filed. So this actually, and if you look at the instructions, it actually says not only for that part of the disclosure, it's actually for the whole return.
Correct, and you're right. That's probably hugely significant because you've doubled your statute of limitations on the entire return over a relatively small amount of omitted income.
So if you took an aggressive position somewhere else on the return, whatever it might be, this is the crack that will open up the audit 6 years later and could lead to a very, very bad result because it normally would be a closed year. And this enables them from our typical 6-year statute of limitations is normally where you have a substantial understatement of gross income.
Yes.
And that's actually a 20, I think it's a 25%.
Right.
That's what constitutes a substantial understatement. This is only $5,000 of gross income that's underreported. So this is actually a very, very low threshold to open up a return which would otherwise be closed. So as a word of caution, this could be something that you have to really take into consideration when filing an 8938 and realize that this has implications across the whole spectrum of other disclosures that you make on your tax return, because it really leads and extends it significantly.
And just to sound like a broken record, when in doubt, file the Form 8938 and disclose, because you don't want to be facing any of those penalties. Some other administrative aspects. The Form 8938, as I think I mentioned at the beginning, is completely separate from the FBAR. The FBAR rules are still unchanged. The FBAR is still due on June 30th under its own criteria about your balance in foreign bank accounts. There are situations where you could have an FBAR requirement and not a Form 8938 requirement, and vice versa. Form 8938 is part of your annual tax filing, usually on Form 1040, and the due date is the same as the 1040. So now we're going to go to our next polling question, which is Form 8938 is due on June 30th. True or false?
It's kind of a tricky question because you were just talking about June 30th.
Oh, it is tricky.
That's not really fair.
We'll see if people are awake for a second. And most everybody's voted. Just another 10 more seconds, and then we'll close the polling. Okay. And of course, that's false. The FBAR is due June 30th without extensions. The Form 8938 is due with the tax return. If your tax return is extended, then Form 8938 is extended as well. Okay, so now we're going to go through this form, and hopefully you either have a Form 8938 available either on screen or on paper, or we're just going to go through some of the aspects of the form that maybe we didn't touch on before. So I'll first point your attention to the upper left-hand corner, the November 2011 revision date. This is not an annual form like a 1040, so always be mindful to make sure that you're using the right form. I always check the IRS website to make sure they haven't updated it, because oftentimes the IRS will update the form, and our tax software has not gotten around to updating it yet. So always focus on that. The Form 8938 contemplates lots of assets. And for every asset, you may be filing and attaching a different page. So if you look, there's the bar right at the top. If you have attached additional sheets, check here. Okay, so keep that in mind. The name shown on the return. It's going to be the same as your tax return. Okay, the name, address, identifying number. The tax year beginning really should be the same as your regular tax return. Now, the tricky part is type of filer. You have a specified individual, and then that specified individual is either going to be married filing a joint return or other, which will be single, married filing separate, head of household. You see the box on the line B, specified domestic entity. For 2011, only individuals have to file Form 8938. We're going to talk about in a few minutes some rules changing for next year that will expand the Form 8938 to some of those other different types of entities. But for the tax returns that you're preparing right now for 2011, you're only going to be concerned with the box or line A. So now let's go to part one. Type of account, depositor custodial account number. So line 3 is the question that Parag and I were talking about earlier in the presentation, that you have to pick one of the or not one, but some of the following choices if they're applicable. Account opened during the year, account closed during the year, account owned jointly with spouse, and no tax item reported in part 3 with respect to this asset. And we'll get to part 3 later on. But like we said before, that if I'm not checking account open during the year, the next natural question the IRS is going to ask is, okay, how is this account and the income associated with the account reflected on prior year's returns? Okay. We skip down to question 6, exchange rate. You'll note right there, there's a source of exchange rate used if not from U.S. Treasury Financial Management Service. The instructions say you can only use another source if the U.S. Treasury Financial Management Service doesn't have the exchange rate for that currency, okay, which is going to be a very rare situation. So now we go to part 2. So part 1 is really going to be my bank accounts for the most part, the types of things that I would see on an F-bar. Part 3 is going to be everything else, other foreign financial assets. Now, if I'm going to be reporting an asset that I'm already filing a form, say 5471 for, I don't list that information. In fact, if you see right there, it says note. If you've reported a specified foreign financial asset on forms 3520 and others, you do not have to include the assets on form 8938. You must complete part 4. Okay. Let's skip over to question 8 on the next page. And on question 8, you have, I'm going to call it the catch-all for all the other lots of different types of entities. So if I have a loan to a non-U.S. person, I'm going to report it there on line 8. Okay. Part 3 is a very important part of the form. Part 3 is kind of the connect the dots part of this form that connects the asset that's being reported on this form 8938 to the spot on the income tax return where the income from that asset is being reflected. Okay. And this is in summary format. Okay, it's not on an asset-by-asset basis. So if you've attached additional sheets and you've checked that box at the beginning of the page, or the first page, you're not going to have a part 3 for each one of those pages. You're only going to have that for the lead form 8938. Okay. So now let's go to part 4 at the bottom. This is the big exception. If I've reported an asset on, say, a form 5471, I simply check the box 5471 and write in the number of forms. Okay. And the one form that I don't know if they left out or they forgot was the form 8891. They didn't give it its own checkbox. And the instructions say that if you have a form 8891 for a Canadian Registered Retirement Plan, you have to check the box for 3520. Okay, don't ask me why, but that's what the rules say. So now let's spend a minute talking about what's going to happen next year and some proposed regulations that have been issued under Section 6038 Cap D. Beginning next year, or actually for years beginning in 2012, certain entities are going to have to file Form 8938. And those we refer to as specified domestic entities. And they're corporations, partnerships, and trusts which meet this criteria, that the entity has an interest in specified foreign financial assets that exceed the 50,000, 75,000 threshold. The entity's got to be closely held by an individual, and the entity's got to meet these 2 tests that at least 50% of the passive income, 50% of its income is from passive sources, or 50% of its assets is from passive assets. Or it could have been formed with the intention of trying to escape reporting under Section 6038 Cap D. So that's going to be in play for next year, okay, but not for the returns that we're preparing right now. So now we have a polling question. For 2011, corporations are required to file Form 8938. True or false? And just let's keep it open for about 10 or 15 more seconds. And while we're doing that, somebody has asked the question, do we need to report rental real property? If I own real property, the real property itself is not subject to Form 8938. Rental income obviously is reportable in your tax return on Schedule E, as if that same rental property was in the United States. The question really is that lease contract a specified foreign financial asset? My guess is I don't think so, but if I'm going to err on the side of conservatism, maybe I would report that on the Form 8938. That's the unanswered question right now as to whether a lease agreement is going to be considered a foreign financial asset. Okay, so let's close the polling question. Of course, the answer is false. That is slated to happen next year. Okay, I'm just going to spend a real minute talking about FATCA in terms of foreign financial institutions. When FATCA was enacted in 2010, there were two sides to it. There was the Form 8938 and the enhanced reporting by individuals. But there's also a whole other aspect of FATCA which is imposed on foreign banks. And in a nutshell, the IRS is trying to enter into information sharing agreements with the foreign banks to try to get the foreign banks to disclose the names of their U.S. account holders. That is going to happen in 2013 in the middle of the year. So you may say, okay, what right does the IRS have to go over to a foreign bank and say, send us the names of your your U.S. account holders? And the mechanism is that there's a 30% withholding tax going to be imposed on all U.S. sourced income that would otherwise not be subject to withholding, whether it be by treaty or by the portfolio debt exception, on that foreign bank. But under this new statute, there is that 30% withholding is going to be imposed if the foreign financial institution does not enter into one of these information sharing agreements.
So I guess, Vinay, they really don't legally probably have a right.
True.
And now they're just saying, we're going to use this hammer on you if you decide to voluntarily ignore our request.
That's exactly true. And there's a lot of stories that you hear from people of foreign banks that are telling their U.S. account holders to simply close their account because they don't want to deal with the costs associated with complying with these rules. And I've just put a link to an Ernst & Young website on there. To the banks, this is a huge project and a huge dilemma because they have so much information reporting to gather. It's really a tremendous project for the banks. Now, I'll leap one step further, is that there's been a lot of press lately about, the U.S. is not the only one concerned with their citizens having accounts in offshore jurisdictions and not paying tax in the United States. Most of the developed countries have the same concern. So in addition to the U.S. going after the foreign banks, the U.S. is also entering into much more robust information sharing agreements with other foreign governments because other foreign governments have the exact same incentive and want to know about these things. So we're going to see just a trend of information sharing. People in U.S. taxpayers who may have had accounts overseas who really thought that they were so far below the radar that there was really no need to bother to report these assets. The trend is going in the other direction. The trend is going that, between the huge penalties Parag just talked about, as well as all this information sharing, that it's really something that has to be addressed sooner rather than later.
And a lot of these foreign banks are complaining. They're either asking for an extension of time, they're lobbying for an extension of time, and some of them are actually saying, I don't want to report it to the IRS, but I might be willing to report it to my own country. For example, the EU, there's some EU countries that are saying, we won't give it to the U.S. government, but we're willing to give it to the EU. And I would think that then the IRS or the government, the U.S. government will enter some type of information sharing agreement with the EU then, which will still get you to the same place where the foreign taxpayer is exposed because they will now get it indirectly, not directly, from the foreign government.
Correct. There was a press release that came out of Treasury not too long ago about that exact topic. So now that we're talking about somebody who may have had a foreign account who doesn't want to comply or hasn't complied with the U.S. rules and now sees the writing on the wall, Parag, what opportunities are there for somebody to come into compliance?
Now, if we had this webinar about 8 weeks ago, I would say not much. But surprisingly, the IRS has come up with a helpful solution. So the IRS reopened the Offshore Voluntary Disclosure Program, which had previously been closed last fall. and there was a very successful program called OBDI in 2011. And to the surprise of many tax professionals, the IRS indicated that they're going to have an indefinitely opened program to enable taxpayers to get current with their foreign and undisclosed accounts. This is the third program that they've had in recent history. They had one in 2009, which was successful. They had one in 2011, which I heard was even more successful. And I guess the IRS sees this as a cash cow, perhaps. And as a result of that, they want to keep this open forever. So just to recap, and we all know that U.S. citizens are supposed to report all of their foreign income on their U.S. income tax return. You also have an FBAR requirement, which requires you to file an FBAR June 30th of the preceding year for that foreign account. And the failure to file the 1040, the FBAR, and now this 8938 results in very substantial civil penalties and criminal charges. So in the backdrop of all this, OVDI and OVDP for 2012 looks like a real viable option for taxpayers who have some risk. So let's just take a step back. 2011 just finished, and has there been any pronouncements from the IRS, any correspondence to the taxpayers that have filed? There were thousands of individuals that came through the program. There's been no movement whatsoever with them. I suspect the IRS is buried with their filings. Just like in 2009, what I expect the IRS to do, and what they're probably doing even as we speak, is that they're data mining, and they're looking at who went to which person in which country, and does the name come up more than once, and they look at all this new information. And the IRS is getting smarter. They are looking for evidence, and they are issuing subpoenas to occasionally to foreign banks when they have evidence. And they are really prosecuting individuals. There is a real criminal aspect to this for taxpayers that have what I think are significant exposure. And what is significant exposure? I give you actually a slide here of this is a doctor who had a foreign account at HSBC over in India, and HSBC, by the way, just a couple days ago indicated that they had the subpoena that was issued against HSBC was voluntarily taken back. Apparently HSBC has shared some information with the Department of Justice. We're not entirely certain what information, but this is an example of what could go wrong. And I use this example. You can take a look at, you can Google the case if you want. And this shows an example of bad facts and bad results. This doctor had $8 million hidden in an offshore account, had about $1.2 million in foreign income, which was undisclosed. Here are some of the bad facts, just to show you what really results in a really bad fact, bad result scenario. He requested that he doesn't want any information at his U.S. address. He transferred the funds abroad from his U.S. bank account in small increments. He used foreign relatives' addresses. And this, I suspect, this doctor has been indicted, and he hasn't been sentenced yet, but I expect him to be convicted. The penalties for that would be at least $250,000, 5 years in prison. You have all these other types of penalties, such as failure to file or filing a false tax return, failure to file FBAR penalties. These are very large amounts. So this brings us to the 2012 OVDP, and the most important thing is that, and this is really the only solution that I'm aware of that can provide 100% risk immunization for a properly filed, completely truthful filing. This provides the risk immunization to a taxpayer that enables them to sleep at night. If they're looking for that level of comfort, this is the only solution. You have quiet disclosures, you have limited disclosures, you have other things, but those don't provide the 100% risk immunization that the 2012 OVDP does.
Parag, why don't you spend 1 minute just kind of, for somebody who's not familiar with OVDP or OVDI programs, basically the structure of it.
Sure. There's a 3-step process. There's a pre-certification type of filing that's done, very, very basic, 1-pager. We fax in. The IRS actually shockingly returns it back just within a couple of days. Make sure you're not on some blacklist. And then you go through a pre-acceptance process where you give a little bit more information about the source of the funds, what the funds are for, the rough numbers of the understatement. And once that is returned and approved by the IRS, then you go through a full submission. This usually takes 6, 8, 10 months to really put together from all these 3 steps all the way to the full submission. And it's a thick package because you're going back 8 years. You're amending returns for 8 years. You're filing FBARs. There's a lot of disclosure here. But it's a great opportunity for the client that wants this immunization, as I said, to be able to escape the risk. And by the way, there is a 27.5% penalty, which is really a very significant penalty on the highest account balance in any of the previous 8 years. So there is a large penalty assessment associated with that.
Parag, did you say 27.5% on the asset or on the income?
No, I said on the asset. So this is a very, very significant, almost confiscatory penalty that you're paying. And we could probably do another hour webinar on this topic alone, but there's a whole opt-out possibility, and there's ways that you could possibly reduce that amount. This is all very unclear at this point. There's been no response from the IRS for really any taxpayer I've heard. My office filed about 4 dozen of these, and we haven't received any response back. So no one knows exactly what happened in 2011, and that will telegraph all the way up to 2012 in terms of whether we're going to be doing that. So again, the key difference is a no deadline. There's 27.5% penalty.
But Parag, to clarify, we do know what the worst case answer is in terms of what the IRS rules are. What we're hoping for is to get some I don't know if leniency is the right word, but hopefully something better than the worst case in terms of the huge penalties.
Yeah, that is the worst case. And what I tell clients is that this is the worst case scenario for you.
Right.
And really the IRS rules in 2011, which we're piggybacking on 2012, you're not required to pay that penalty when you file the full submission. So there's going to be a discussion about that for most of my clients about whether we're going to pay that, and whether we're going to have a real one-to-one with the examiner to see whether there's any possibility of a reduction. And this is a project. It's not for the timid. It really isn't. So the benefits of coming clean, as I mentioned, that the voluntary disclosure provides 3 significant benefits. The risk of criminal prosecution goes away if it's a complete and truthful filing. The civil penalties are reduced because you're not paying all of them. You're paying, in this case, 27.5 in lieu of all the other penalties. And it gives you the certainty that you know that what you're going to be paying. And even if your failure to comply was inadvertent, taking the chances with an IRS audit can be very risky, because if you don't go through the OVD program, and if you're audited, you're going to have a major process.
And the whole movement behind Form 8938 is that we're going in the direction of full disclosure. So if you have exposure in the past, this is something you should really take a look at and encourage your clients to look at these prior years and not just bury your head in the sand. And then Parag has some information. He keeps up with this on his website, so you can see the link to his blog there. Here is the contact information for Parag and myself. We're right at the 1 hour mark, and it's really been a pleasure having this discussion with you. If you have any questions, feel free to call or email any of us. And again, thank you for joining us, and we'll sign out. Bye-bye.